Welcome to Breaking News to Trading Moves. Today, we're diving into something that's really shaking things up. Coffee prices.
Yeah.
Just a sudden, dramatic surge.
Yeah, it's pretty wild. Futures are spiking towards record highs.
Exactly. And it seems to be this, well, perfect storm, right? You've got U.S. tariffs hitting some key producers, plus this really relentless dry weather hitting Brazil's crops hard.
Bone-dry conditions, yeah. Devastating for the harvest.
So this isn't just, about your morning coffee getting more expensive, though it might. It's a major market event. We're seeing real winners and losers emerge in the trading world.
Absolutely.
Our goal here is to really unpack how this volatility, this price pressure is affecting everyone from big consumer brands to the agricultural traders. We want to identify some potential long and short trading ideas based on the analysis we've seen.
And it's crucial to understand the why. It's not just one thing. It's the combination geopolitical stuff like tariffs squeezing supply, layered onto environmental problems like this drought. That's what creates these extreme dislocations in commodity markets.
Dislocations?
Yeah, like major disruptions. And these disruptions, they create unique opportunities.
Right.
If you could figure out quickly who's set up to gain and, who's going to lose out, even companies with hedging strategies might struggle with a surge this big.
Right. Hedging isn't foolproof when things move this fast and this far. Okay, so let's unpack this. Let's start with the companies that might actually benefit from all this upheaval, our long ideas. This is where it gets interesting, how volatility can actually be, well, profitable for some.
Exactly. It's counterintuitive sometimes. So think about the exchanges themselves. Take ICE, Intercontinental Exchange, ticker ICE.
Okay, where coffee futures trade.
Right. When prices go wild like this and volatility jumps, what happens? Trading volume explodes, open interest goes up, people are hedging, speculating.
More activity.
Tons more activity. And for ICE, that means more transaction fees, more clearing revenues. It feeds directly into their bottom line. Market chaos can actually be pretty good business for the exchange.
So they benefit from the churn, regardless of the price direction, really. Okay, understood. What about companies involved more directly with the commodity itself, managing the risk?
Yeah, that's where a firm like SNX, StoneX Group, comes in, ticker SNEX. They're a big commodities brokerage.
Right.
So when you have roasters, manufacturers, anyone using coffee facing these tariff issues or sudden price spikes, what do? They scramble. They need alternative supplies, maybe from different countries. They definitely increase their hedging.
They need help managing the risk.
Exactly. They need brokerage services, risk management advice, help finding those new supplies. All that increased demand. It flows right to StoneX, boosting their business, their revenues. They thrive when things get uncertain and complex.
Okay, that makes perfect sense. The complexity drives business their way. Now, what about the huge agricultural companies, the ADMs of the world? How do they play this?
Now that's where scale really matters. Look at ADM, Archer Daniels Midland, ticker ADM. They have massive global trading desks and infrastructure.
Logistics, storage, the works.
The works. So in disrupted markets like this, you often see spreads widen out. Things like basis spreads, the difference between the spot price now and the futures price later, or freight spreads.
Okay.
ADM is perfectly positioned to capitalize on that. Their traders can manage these wider margins. And crucially, if, say, the Brazil to U.S. route gets difficult because of tariffs or lack of beans, ADM can use its global network to source coffee from elsewhere, maybe Vietnam, Colombia, manage the complex shipping, and basically profit from the reshuffling of these trade routes.
So their global reach and logistics network lets them turn that disruption into an opportunity. Arbitrage, essentially.
Precisely. Arbitrage on a global scale. They can navigate the chaos better than almost anyone.
Wow. Okay. Are there others like ADM benefiting similarly?
Yeah, definitely. You got BG, Bungie Global, ticker BGG. Very similar setup to ADM, big agricultural merchandising operations, global reach. So as these trade routes shift, maybe away from Brazil to the U.S., Bungie is also in a great spot to benefit from those wider spreads and the general need to reroute commodities around the world. Their integrated system, from sourcing beans to processing and shipping, lets them capture value when the supply chain gets stressed.
Okay, so the giants with the global networks have an edge. Now, you mentioned sometimes there are more direct plays. Maybe more speculative?
Yeah, for a more, let's say, direct bet on the coffee price itself, you could look at a smaller company like JVA, Coffee Holding Co. Ticker JVA.
Smaller cap, you said.
Right. And they have very direct exposure to coffee prices. We talk about high beta with stocks like this. It basically means JVA's stock price tends to move more sharply than the coffee price itself.
Amplified moves.
Exactly. If coffee futures jump 5%, JVA might jump, say, 10% or more. So it's a way to play the price direction, but it comes with higher risk, naturally. The swings can be much bigger, both up and down.
Got it. Higher potential reward, but definitely higher risk. Okay, that covers some potential winners. Now let's flip the coin. Because while some are navigating this well, others are really facing headwinds, feeling the squeeze from these high prices. These are our short ideas.
And this is where those rising input costs really start to hurt margins. Think about SBUX, Starbucks, ticker SBUX.
They
The
need
huge amounts of high-quality Arabica beans.
their core product.
Absolutely. So when those costs approach record highs, it puts immediate pressure on their gross margins. Now, sure, Starbucks has brand power. They can try to raise menu prices.
But there's a limit. Right.
There's always a limit. Raise prices too much or too fast, and even loyal customers might buy less or come in less often. It's a balancing act. So even if they plan to pass costs on, there's often a lag, and during that lag, profitability gets squeezed. Even their hedging can only do so much against such a sharp, sustained rise.
So even a giant like Starbucks feels it. Okay. What about other big consumer brands that sell coffee in, say, grocery stores?
Oh yeah. Look SJM, JM Smucker, ticker SJM. Think Folgers, Cafe Bustelo, massive brands,
Household names.
huge coffee footprint. And despite whatever hedging they do internally, the sheer volume of beans they buy makes their roasting business incredibly sensitive to price hikes. Every penny increase in green coffee costs them millions. It hits their bottom line directly and makes it harder to compete on price in the grocery aisle.
You can really see the scale of the impact there.
Definitely. And then you have KDP, Keurig Dr. Pepper, ticker KDP. They dominate the K-Cup single-serve market.
Right, the pods.
They face the same green coffee inflation. And just like Starbucks, passing those costs on to consumers via higher K-Cup prices takes time. Plus, that market is super competitive. Raise prices too quickly, and people might switch to cheaper pods. So there's that margin squeeze while they wait to adjust pricing.
The convenience factor doesn't make them immune. Okay, what about restaurants where coffee is maybe not the only thing, but still really important?
Good example, QSR, Restaurant Brands International, ticker QSR. Think specifically about Tim Hortons.
Huge in Canada, big elsewhere too. Very coffee-focused.
Extremely coffee-focused. It drives a lot of their traffic. So sustained high bean prices directly increase their cost of goods sold, their KGS, big time. Plus, it increases the risk they might have to run discounts or promotions on coffee just to keep people coming in the door, especially when competitors might be doing the same.
So higher costs and maybe pressure to lower prices through deals, that's tough.
It's a double whammy. Higher input costs, potentially lower realized prices per cup due to promotions. Really eats into profits.
Okay, one more. Are smaller chains maybe even more vulnerable?
Yeah, that's a good point. Take BROS, Dutch Bros, ticker BROS. They're growing fast, but they're still much smaller than, say, Starbucks or even Tim Hortons.
Less scale, less buying power.
Exactly. Less scale means less leverage when buying beans. They're more exposed, less able to absorb these big cost spikes without it hitting their bottom line hard and fast. They just don't have the same financial cushion or potentially the same kind of long-term supply contracts that giants might have. They feel the pinch much quicker.
That makes sense. The scale really matters on both sides of this, the winners and the losers. Okay, so stepping back, what does this all really mean for you listening in and watching the markets? We've seen how one single commodity, coffee, can create these really distinct groups, winners and losers, across so many different industries.
And the key takeaway, I think, is that understanding these impacts, both the direct ones, like input costs, and the indirect ones, like how exchanges or brokers benefit, is really crucial if you want to truly understand what's driving market news. It shows you that supply chain issues, commodity prices, they aren't isolated. They directly hit company values, margins, strategy, everything.
It goes way beyond just the headline price of coffee.
Way beyond. And it raises a really important question, doesn't it? How fast can these companies actually adapt? Can they adjust pricing quickly enough? Can they reroute their supply chains effectively? The answers really determine who thrives and who struggles in these situations.
We've definitely covered a lot of ground today, from, the drought in Brazil and the tariffs, all the way to specific companies like ICE and Starbucks and how they're navigating this. It really underscores how interconnected everything is in the global economy.
It really does. And what's fascinating, I find, is how something seemingly faraway weather patterns trade policy decisions creates this domino effect that impacts your wallet, your morning routine, and the profits of huge multinational corporations. It really challenges you to think, where else might these hidden sensitivities be lurking in the markets we follow?
Absolutely. Something to keep in mind as you watch other commodities and sectors. Okay, before we wrap up, just a quick reminder. This discussion was purely for informational purposes. It reflects opinions based on the author's analysis.
Right, it's not financial advice.
Definitely not.
Yeah.
And it doesn't constitute any recommendation to buy or sell any of the stocks or securities we talked about today.